Hello, everyone, and welcome back to an Introduction to Investing for Canadians, a series created to teach young Canadians the fundamentals of budgeting, saving, and investing. We're going to look at the difference between an exchange and an indexee, what these look like within North America, what they look like in other parts of the world, and how to use them to actually measure your investment performance. You'll often hear the term stock market and stock exchange used interchangeably, and that is because they are the exact same thing. A stock exchange is essentially a traditional market, a place where buyers and sellers can meet to exchange goods and services. But in this case, the goods being exchanged for money are stock shares in a company. Today, almost all stock exchanges are now electronic marketplaces. There are hundreds of stock exchanges in the world. The 20 largest exchanges by market cap are shown on the map, and as you can see, many of them are in Asia and Europe. North America is home to 3 of the top 20. Even within North America, there are dozens of smaller stock exchanges in cities such as Chicago, Boston, Philadelphia, Montreal, and Calgary. However, the only 3 that we really care about are the New York Stock Exchange, the NASDAQ, and the Toronto Stock Exchange. But that's not just us. Everyone cares about the New York Stock Exchange and the NASDAQ, as they're ranked number 1 and number 2 amongst the world's largest stock exchanges. The Toronto Stock Exchange currently sits at number 11 in the world. Both the NYSE and the NASDAQ headquarters are located in New York City, while the TSX headquarters is located in Toronto. Only the NYSE has a physical trading floor, although it remains open as more of an iconic tourist attraction rather than a functional exchange. The New York Stock Exchange is the oldest of the 3, and it was founded in 1792, followed by the TSX in 1861. The NASDAQ wasn't founded later until 1971. But the NASDAQ was a pioneer of digital trading. It became the world's first digital stock exchange when they first opened in 1971. The NYSE and TSX soon followed. The TSX opened for digital trading in 1987 and further closed the physical trading floor in 1997. One interesting fact is that the oldest modern securities exchange in the world was the Amsterdam Exchange, founded back in 1602. The NYSE and NASDAQ are the 2 largest stock exchanges in the world, with market caps of 25.9 and 19.4 trillion respectively. The TSX sits at number 11 in the world with a $3.1 trillion market cap. All 3 stock markets boast a plethora of stocks listed on them. The NYSE with 2,400, the NASDAQ with 3,300, and the TSX with 2,200. Now, not just anyone can be listed on these major stock exchanges. For example, to qualify for an NYSE listing, a company must have at least 1.1 million shares of publicly traded stock and have a market value of at least 40 million. The company must also show profitability by proving it can meet specific annual earning criteria. The New York Stock Exchange has broad discretion in listing companies and will only list companies it deems suitable for the market's auction trading process. Even if a company meets all criteria, the NYSE can apply more stringent criteria to them. Many people often confuse the difference between a stock exchange and a stock index, but as we spoke previously, a stock exchange is just a place where buyers and sellers can meet to exchange securities. A stock index is a mathematical average of a specific group of stocks. They are published by financial analytic companies instantaneously and made available to the public. Every major stock exchange in the world has a corresponding index or multiple indexes to track their performance. An index typically serves 2 purposes. The first is to measure the performance of a particular economy or industry. This means that if the index, such as the S&P 500, is increasing, the American economy is healthy and growing. Or if the S&P TSX index takes a massive dip, it may indicate the Canadian economy may be in distress. The second purpose is to provide a benchmark for investors to compare their annual performance to. If an investor decided to purchase a variety of stocks, which resulted in a 15% gain by the end of the year, they could compare this gain to an index to see how their investments did. If their gain was higher than the index, they were a good investor, but if their gain was lower than the index, they were a bad investor. Going back to our map of world stock exchanges, each and every exchange has a corresponding index to measure the performance of the market. In fact, most stock exchanges will have multiple indexes measuring the performance. Looking globally, we can see the Japan Stock Exchange has the Nikkei 225, the Brazil Stock Exchange has the Bovespa, and the Frankfurt Stock Exchange has the DAX. Just within North America, there are thousands of indexes. The four most widely used are the Dow Jones Industrial Average, the Standard & Poor's 500, the NASDAQ Composite, and the Standard & Poor's TSX Composite Index. Each index is composed of a different number of companies, sometimes from different stock exchanges. The Dow Jones and S&P 500 pull from both the New York Stock Exchange and the NASDAQ Stock Exchange. The NASDAQ Composite Index pulls exclusively from the NASDAQ Stock Exchange, while the S&P TSX Index pulls exclusively from the Toronto Stock Exchange. The Dow Jones and S&P 500 track the performance of the U.S. economy, while the NASDAQ tracks the performance of the U.S. technology sector. The S&P TSX Index tracks the performance of the Canadian economy. The ages of all these indexes vary. The Dow Jones is a much older index, dating back to the 19th century. The S&P 500 was created during World War II, while the NASDAQ Composite and S&P TSX indexes were not created until the 1970s. All indexes are operated by major financial analytic companies. At any point in time, each index is represented by a price. The method in which this price is calculated is different among them. The Dow Jones is calculated using the weighted average method. This involves summing the share price of all 30 stocks and dividing it by a constant known as the Dow divisor. Stocks with a higher share price weigh more heavily on the value of the index than stocks with a lower share price. The value of the S&P 500, NASDAQ Composite, and the S&P TSX Index are calculated using a weighted market capitalization method. This involves summing the market caps of all the stocks within the index and dividing by a constant. Stocks with a higher market cap also weigh more heavily on the value of the index. Being listed on one of these indexes is a big deal, as companies are selected by a committee. For the Dow Jones, there are no specific rules. However, each company must account for a significant portion of the economic activities in the U.S. and must also be listed on either the NASDAQ or the New York Stock Exchange. And changes to the stocks listed on the Dow Jones rarely happen. There's only been 55 changes in the Dow's 125-year history. For the S&P 500, minimum criteria is set, such as market cap, trade volumes, age, and recent earnings. Oh yeah, and even if a company meets all this criteria, they still must be deemed American enough by the committee to be included. The NASDAQ is a bit different. The selection process is not as exclusive. Once a stock is listed exclusively on the NASDAQ Stock Exchange, it is included on the NASDAQ Composite Index. There are some exceptions with preferred stocks and ETFs. If you recall from the previous slides, the Dow Jones uses the weighted average method to calculate the value. This involves summing the current trading price of all 30 stocks contained within the Dow and dividing by a constant known as the Dow divisor. 20 of the 30 stocks listed on the Dow are shown in the table. As an example, if Home Depot and Walt Disney each were to increase 5% in value, the Dow Jones would be more heavily influenced by Home Depot due to its higher trading price. The S&P is similar, except rather than solely using the market price of each stock, it uses the market cap to calculate the value of the index. This chart shows the top 20 of 500 stocks contained within the S&P 500, and so forth for the NASDAQ Composite and the S&P TSX Index. When we look at the performance of the four major indices over the previous year or previous 5 years, the NASDAQ Composite has significantly outperformed the other three. As I mentioned earlier, the NASDAQ is the newest of all the indexes and tends to attract primarily tech companies. The performance of the NASDAQ is proportional to the performance of the tech industry over the past 5 years. There are 3 important points that we covered in this video that I'd like to review. The first is that a stock exchange is a digital marketplace where buyers and sellers can gather to trade shares of securities. There are hundreds of stock exchanges all over the world, and the 2 largest exchanges are both located in New York City. Number 2, a stock index is a mathematical average of a specific group of stocks. They are published by financial analytic companies instantaneously and made available to the public. Every major stock exchange in the world has at least one corresponding index. Some of the largest exchanges, such as the ones in North America, will have multiple stock indexes. And number 3, indexes are an important tool to investors and have two primary functions. They measure the health of a particular economy or industry, and they provide a benchmark for investors to compare their annual performance to. Thank you again for listening, and see you next time where I talk about fixed income and equity investments. If you enjoyed this video, don't forget to subscribe to the channel.